Euro to US dollar analysis. Euro strengthens amid EU-US trade tensions. Hold on to your seats, this week could be a turning point for the euro and the broader Forex market. With the August 1st tariff deadline fast approaching, all eyes are on the high-stakes negotiations between the European Union and the United States. The euro has managed to edge above $1.1650, but the real drama is just beginning. Will the EU stand its ground, or will it cave to US pressure? And this is the part most people miss: the outcome could reshape global currency trends for months to come. Let's break down what's happening. Euro banknote: euro gains ground as EU strategizes. The euro's recent climb past $1.1650 isn't just a random blip. It reflects cautious optimism or perhaps calculated risk-taking as traders anticipate the EU's next move. The European Union is reportedly considering dismissing President Trump's latest letter, signaling a possible willingness to confront the US on trade. This alone is enough to inject uncertainty into the markets, and the euro's modest rise is a sign that investors are bracing for volatility. Chart increasing: a macro week packed with potential surprises. This week is shaping up to be a roller coaster for currency traders. The looming August 1st deadline is like a storm cloud on the horizon, with the threat of new US tariffs hanging over the market. If the EU refuses to yield, the US could escalate trade tensions, sending shockwaves through the Forex world. The euro's current strength may be a sign that some traders are betting on a last-minute compromise, or at least pricing in the possibility of a dramatic standoff. But here's where it gets controversial. Some analysts argue that the euro's resilience is misplaced, given the lack of a clear EU response and the potential for sudden market swings. Are traders underestimating the risks? Classical building: central banks take center stage. Adding another layer of complexity, central bank decisions are front and center this week. On Tuesday, Federal Reserve Chair Jerome Powell is set to speak, and every word will be scrutinized for hints about future interest rate moves. While the Fed has paused its rate hikes, persistent inflation and a robust job market keep the debate alive over whether rates will stay higher for longer. This uncertainty is fueling speculation and could trigger sharp moves in the dollar. Later in the week, the European Central Bank is expected to keep its key rate steady at 2% on Thursday. ECB officials have recently adopted a more balanced tone, trying to juggle sluggish economic growth with ongoing inflation concerns. This cautious approach is meant to avoid adding fuel to the fire as trade tensions simmer. Between geopolitical maneuvering and central bank policy, the euro-dollar pair is set for a week packed with headline risks. For traders, this means heightened opportunity but also greater danger. Are you ready to navigate the turbulence, or do you think the risks outweigh the rewards? And here's a question for you: do you believe the EU should stand firm against US pressure, or is compromise the smarter path? Share your thoughts below. Let's get the debate started. EURUSD forecast update, July 22, 2025, bullish trends and trading signals. Are you ready for a market shakeup? Today's Forex landscape is shifting, and the latest forecasts are stirring up plenty of debate among traders. Let's break down what's happening with EURUSD, CAD, EURJPY, and GBPJPY, and why these moves could matter for your next trade. But here's where it gets controversial: not everyone agrees on what these signals mean for the days ahead. Will you side with the bulls or the bears? EURUSD forecast, July 22, 2025. After a period of overbought conditions, the EURUSD has managed to climb higher in recent intraday trading. This upward momentum was triggered as the pair worked off its overbought status on the Relative Strength Index, RSI, which often signals a potential for further gains. What's especially interesting is that EURUSD has broken above a short-term bearish trend line, a move that many technical analysts see as a bullish sign. On top of that, the pair is trading above the 50-period exponential moving average, EMA 50, which acts as a dynamic support and adds to the bullish momentum. And this is the part most people miss: breaking a trend line doesn't always guarantee a sustained rally, so is this a true breakout or just a temporary blip? High-accuracy trading signals, powered by besttradingsignal.com. If you're looking for an edge in the markets, besttradingsignal.com offers meticulously crafted trading signals for US stocks, cryptocurrencies, and Forex. Subscribers receive real-time alerts directly via Telegram from a team of seasoned experts. Packages start at just €44 per month for US stock signals, 49 euros per month for crypto or Forex, and 179 euros per month for VIP signals covering gold, oil, major indices, and top cryptocurrencies like Bitcoin and Ethereum. The longer you commit, the bigger your discount, so it pays to think long term. Want to see proof? Check out their full performance results for the week of July 14th to 18th, 2025, on their website. CAD forecast, July 22nd, 2025. The CAD pair is under pressure, and the outlook isn't looking bright for bulls. The price has slipped lower in recent intraday sessions, weighed down by a persistent short-term bearish correction. The pair is hugging a downward bias line and remains below the EMA 50, which is a classic sign of ongoing negative momentum. Even though the RSI is showing oversold conditions, a level where some traders might expect a bounce, there's still no sign of bullish energy returning. So, what's next? If resistance holds at 0.5835, the pair is likely to target the key support at 0.5820. The expected trading range for today is between 0.5820 and 0.5835, with the overall trend forecasted as bearish. But here's a question for the crowd. Do you think the oversold RSI could spark a surprise reversal, or is the downtrend just too strong? EURJPY forecast, July 22, 2025. EURJPY continues to impress, extending its gains in the latest trading sessions. The pair has benefited from positive signals on the RSI after previously dipping into oversold territory. Trading above the EMA 50 has provided additional support, reinforcing the main bullish trend in the short term. As long as EURJPY stays above 172.25, the next target is the critical resistance at 173.25. The anticipated trading range for today is 171.85 to 173.25, with a bullish trend forecast. But here's the twist: some traders argue that the rally could be running out of steam. Do you see more upside ahead, or is a pullback overdue? GBPJPY forecast, July 22, 2025. GBPJPY is making a comeback, attempting to shake off recent negative pressure. The pair has bounced higher, finding support from a minor bullish trendline on the short-term chart. This move has injected some positive momentum, even as the RSI flashes negative signals after reaching oversold levels. The pair is now challenging the resistance of the EMA 50, aiming to confirm a full recovery. If support holds at 198.70, GBPJPY could climb toward the key resistance at 199.80. Today's expected range is 198.75 to 199.80, with a bullish outlook. But here's a controversial take: is this recovery sustainable, or just a temporary reaction to oversold conditions? High-accuracy trading signals, your market advantage. BestTradingSignal.com continues to offer comprehensive signal packages for all major markets. Whether you're trading US stocks, crypto, Forex, or looking for VIP coverage across multiple asset classes, you can receive expert signals straight to your Telegram. The longer you subscribe, the more you save, so why not lock in a better rate? Curious about their track record? See the full results for the week of July 14th to 18th, 2025, on their website. Quick FAQ: what's the euro to US dollar price right now? As of July 23, 2025, at 4:55 a.m. Universal Time Coordinated, euro to US dollar is trading at $1.1735. Now, let's open the floor. Do you agree with these forecasts, or do you see the charts telling a different story? Are you betting on a reversal in CAD, or do you think EURJPY and GBPJPY have more room to run? Share your thoughts and let's get the debate started in the comments below. Euro to US dollar surges past 1.1740 ECB decision and 1.1800 target, July 2025 forecast. When it comes to the world of foreign exchange, few things are as captivating as watching a currency pair like euro to US dollar make significant moves. Recently, this pairing has surged above the 1.1740 mark, driven by a combination of factors that have weakened the US dollar and placed the European Central Bank, ECB, squarely in the spotlight. For those keeping an eye on global financial trends, this is shaping up to be a pivotal moment. But here's where it gets controversial. While some analysts see this as a clear sign of shifting economic power, others argue it's just a temporary blip. What do you think? the euro to US dollar exchange rate has shown remarkable resilience, staying firmly above the critical 20-day simple moving average (SMA) at 1.1704. This stability has allowed the pair to hit a daily high of 1.1747 after dipping to a low of 1.1678 earlier in the session. The driving force behind this surge? A noticeable improvement in risk appetite, which has pressured the US dollar despite lingering concerns over whether the European Union (EU) and the United States (US) can finalize a trade deal before the looming August 1 deadline. For traders and investors alike, the story unfolding in the markets right now feels both familiar and frustrating. Over the past 24 hours, US equities closed with mixed results, failing to provide any clear direction. However, trade-related headlines continue to dominate the news cycle. In one notable development, the US announced a new agreement with the Philippines, a move that offered only limited support for the dollar. Meanwhile, progress on negotiations with the EU remains elusive, leaving many wondering if these talks will ever bear fruit. Adding another layer of intrigue to the situation, U.S. Treasury Secretary Scott Bessent emphasized that the White House prioritizes the quality of trade deals over their timing. When questioned about potentially extending deadlines, he left the decision in the hands of President Donald Trump. This raises an interesting question: should we expect flexibility from the administration, or will strict deadlines prevail? And this is the part most people miss: the subtle signals from policymakers often carry more weight than explicit statements. While all eyes remain fixed on the transatlantic trade drama, European leaders are preparing for high-level meetings with counterparts in Japan and China. According to Bloomberg, discussions with Japan will focus on defense and trade cooperation, though expectations for breakthroughs during talks in Beijing appear muted. These diplomatic efforts underscore the broader geopolitical landscape influencing currency movements. On July 24, the ECB is set to announce its latest monetary policy decision, and anticipation is building. Market participants widely expect the central bank to maintain current interest rates, given that inflation is nearing its target range. Nevertheless, ongoing trade uncertainties mean that no outcome is guaranteed. It's worth noting that the probability of the ECB holding rate steady stands at 57.5%, while there's a 42.5% chance of a modest 0.25 percentage point cut. Interestingly, these odds shifted slightly compared to the previous day, climbing from 37.5% to 42.5%. Could this signal growing concerns within the market? Looking ahead, the economic calendar promises plenty of action. In Europe, key releases include consumer confidence figures, flash PMIs for July, and the ECB's highly anticipated policy announcement. Across the Atlantic, the U.S. will release housing data, S&P Global flash PMIs, initial jobless claims, and durable goods orders. Each of these reports could sway sentiment and influence the trajectory of euro to US dollar. From a technical perspective, the outlook for euro to US dollar appears bullish. After posting consecutive days of gains, the pair has breached the 20-day SMA at 1.1709. Momentum indicators like the Relative Strength Index, RSI, suggest buyers are firmly in control, having pushed the RSI toward the 60 mark from neutral territory. If euro to US dollar climbs above 1.1750, analysts predict a test of the psychologically significant 1.1800 level. Should the pair falter below 1.1700, however, downside risks emerge. Key support levels would then come into play at 1.1600, followed by the 50-day SMA at 1.1532, and finally 1.1500. Before diving deeper, let's address some frequently asked questions about the euro. As the official currency for the 19 EU member states comprising the Eurozone, the euro plays a vital role in global finance. It ranks second only to the US dollar in terms of trading volume, accounting for approximately 31% of all foreign exchange transactions in 2022. With an average daily turnover exceeding $2.2 trillion, it's no wonder euro to US dollar dominates as the world's most traded currency pair, representing roughly 30% of total Forex activity. Other popular pairs include euro to Japanese yen, 4%, euro to pound sterling, 3%, and euro to Australian dollar, 2%. At the heart of the Eurozone's monetary system lies the European Central Bank, ECB, headquartered in Frankfurt, Germany. Tasked with setting interest rates and managing monetary policy, the ECB operates under a mandate to ensure price stability. Typically, this involves controlling inflation or stimulating growth through adjustments to interest rates. Higher rates, or even the expectation of future increases, tend to bolster the euro, whereas lower rates have the opposite effect. Decisions are made by the ECB Governing Council, composed of heads of national central banks and 6 permanent members, including President Christine Lagarde. They convene 8 times annually to deliberate on policy changes. Inflation data, measured using the Harmonized Index of Consumer Prices, HICP, serves as a crucial indicator for the euro. If inflation exceeds expectations, particularly surpassing the ECB's 2% target, the central bank may respond by hiking interest rates to rein it in. Such measures typically benefit the euro, making the region more appealing to global investors seeking higher returns. Conversely, weak economic performance tends to weigh on the single currency. Data points such as GDP growth, manufacturing and services PMIs, employment figures, and consumer confidence surveys all contribute to shaping the euro's fortunes. Among individual nations, economic updates from Germany, France, Italy, and Spain hold outsized importance since they collectively represent 75% of the Eurozone's economy. Another critical metric for assessing the euro's strength is the trade balance. This figure tracks the difference between a country's export earnings and import expenditures over a specific period. A positive balance indicates that exports exceed imports, creating additional demand for the local currency from international buyers eager to purchase goods. Naturally, this strengthens the currency, while a negative balance has the reverse effect. As always, navigating the complexities of financial markets requires caution and diligence. Information provided here includes forward-looking statements subject to inherent risks and uncertainties. Markets and instruments discussed are presented purely for educational purposes and should never be construed as investment advice. Always conduct your own comprehensive research before committing capital, as investing in open markets entails substantial risk, including potential loss of principal and emotional stress. All decisions, risks, and costs associated with trading are solely your responsibility. Lastly, it's essential to recognize that the views expressed in this analysis belong exclusively to the author and do not necessarily align with those of FX Street or its advertisers. Unless explicitly stated otherwise, the author holds no positions in any stocks mentioned and maintains no business relationships with companies referenced herein. Compensation for writing this article was received solely from FX Street. Neither FX Street nor the author provides personalized recommendations, and neither party assumes liability for errors, omissions, or damages arising from the use of this information. Finally, remember that neither the author nor FX Street qualifies as registered investment advisors, and nothing contained herein constitutes formal investment guidance.